Bitcoin. For years, it was kind of seen as this niche digital curiosity. Well, that era is over. It's now being seriously looked at by some of the biggest financial players on the planet. But how are these giants approaching an asset that's so famously volatile? Let's break down their playbook.
First, let's start with a number just to frame this whole conversation. $155 billion. That's the amount of money that could potentially flow into Bitcoin from just one sector. We're talking wealth management platforms, if they make a tiny 1% allocation. So yeah, we're talking about a massive wave of capital. And honestly, that's just the start.
So the big money is definitely showing up to the party. But that raises two really important questions for any serious investor, right? First, why are they suddenly so interested? And maybe more importantly, how are they planning to invest in this stuff without, getting totally burdened? That's what we're going to unpack.
And this gets to the heart of it all. There's been a fundamental shift in the Bitcoin story. It's not just about individual crypto enthusiasts anymore. We are literally watching major institutions and even entire countries step into the ring.
And when you look at who's getting involved, the list is getting longer and a whole lot more sophisticated. You've got your wealth management platforms and brokerage accounts making it easy for people to get in, but it goes way bigger than that. We're seeing nation-states getting into Bitcoin mining, and there's serious talk about sovereign wealth funds and even national reserves adding it to their balance sheets. The game has totally changed.
So what is pulling all of this capital in? Well, if you have to boil it down to one word, it's returns. The historical performance of Bitcoin has just been so out there that the institutional fear of missing out, the FOMO, is becoming impossible for them to ignore.
I mean, just look at this chart. What's crazy isn't just one lucky year, it's the sheer number of them. We're seeing multiple years with triple-digit and in one case a quadruple-digit return. That's the kind of performance that forces portfolio managers to sit up and pay very close attention. To really make that sink in, let's just focus on 2013. A return of over 5,000%. What does that actually mean? It means if you had put in just $18,500, it would have turned into over $1 million in 1 year.
And this slide just puts it in perfect perspective. To get that same kind of gain from a traditional S&P 500 investment just based on its historical average, you would have had to wait around 37 years. Bitcoin did it in 12 months. Okay, but before anyone gets too excited, we have to be brutally honest here. There's a reason they say there's no such thing as a free lunch. With those kinds of returns comes an absolutely massive risk. And with Bitcoin, that risk is on a whole other planet. You have to be ready to, as they say, hold on for dear life. Now look at this. After seeing that chart of incredible gains, this one shows the other side of the story. Every single one of those huge red drops for Bitcoin is a bear market, a fall of 20% or more. The number of them and how deep they go, it's just staggering compared to the S&P 500. Since its inception, Bitcoin has had 19 bear markets. 19. Just think about the kind of stomach you'd need to have to ride that out 19 times. Now, for comparison, the S&P 500 over that same period, 2. Just 2. The difference in volatility isn't just a small detail. It's pretty much the entire story when you're talking about risk. And here's where it really hits home. If you're invested in traditional markets, you get some breathing room. The median time between big 10% drops for the S&P 500 is over 300 days. But for Bitcoin, it's just 14 days, 2 weeks. It is absolutely relentless. So how on earth do you handle an asset that's this potent? Well, the pros think of it like a ghost pepper. A tiny, tiny little bit can add an incredible amount of flavor, or in this case, return to a dish. But if you add too much, the entire meal is just ruined. And that's exactly how they're approaching Bitcoin in a portfolio. Which brings us to the how. The professionals aren't just blindly throwing money at Bitcoin. They're using some really smart portfolio construction techniques to try and tame this beast, to harness its power without completely blowing up their clients' financial goals. And if you look at the data from the last decade or so, you see the trade-off crystal clear. An annualized return of 55% for Bitcoin versus 13% for the S&P 500. I mean, that's amazing. But here's the catch. Look at the volatility, more than 3 times higher. And the max drawdown, a devastating 83% drop. That's a portfolio killer. But this is where the real portfolio magic happens. When you start blending the two, you get some fascinating results. Check this out.
by putting just 8% into Bitcoin. This analysis shows you could have historically matched the risk level of the S&P 500, but with a return of 23% instead of 13. That is a huge, huge improvement.
And that right there, that is the absolute key. This is the big takeaway from how the institutions are thinking. Nobody smart is suggesting you sell all your stocks and go all in on Bitcoin. The real goal is to use a small, strategic slice to potentially enhance the portfolio you already have.
So let's really drive this point home and look at that ghost pepper effect in action, because the impact these small allocations can have is truly, well, disproportionate. Now, this is where it gets kind of wild and totally counterintuitive. By adding just a tiny 1% slice of Bitcoin to a 99% S&P 500 portfolio, this historical analysis shows it not only boosted returns, but it actually lowered the overall risk of the portfolio. Think about that. More return for less risk. That's pretty much the holy grail for investors. But here's where you feel the heat of that ghost pepper. Remember that portfolio with an 8% slice of Bitcoin? Well, that small 8% of the pie was responsible for a whopping 25% of the portfolio's total risk. A small piece is creating a huge chunk of the volatility. And that all leads to this critical warning: large allocations without proper risk management can severely impact investment objectives. In other words, you have to respect the power of that ghost pepper, or you're going to get burned. So at the end of the day, it all comes down to a personal decision. The institutional playbook shows that even tiny allocations can be incredibly powerful. But the question every single investor has to ask themselves isn't just about the potential for life-changing money. It's about their true, honest-to-goodness tolerance for gut-wrenching risk. And that's a line only you can draw for yourself.